All right, so here we go. I'm really excited to introduce our speaker today. We have Oren Shani with us. Oren is a credit advisor and certified business coach with Axion Opportunity Fund. He has over 10 years of experience managing businesses and advising other business owners. He's started, managed, and expanded his own business, providing disability accommodations for live events across the country. He now helps entrepreneurs launch and grow their own businesses. Thank you so much for being here, Oren.
Thank you, Brittany. Happy to be here. Thanks for having me. Welcome all. I was taking a look at the chat and seeing all these lovely businesses that I'll be speaking to today. So it's a pleasure. It's an honor. Small businesses drive our economy. It's so important. So thank you all for taking that scary, scary step into the world of entrepreneurship. It's very much needed. So it's a pleasure to be speaking with you all today. We'll talk a little bit about the most exciting subject in the world, which is taxes. So happy to do so. Should we just get into it, Brittany?
Yeah, I have a quick announcement before I throw it completely over to Oren. Because I like to take up the first couple of minutes of this, but I just wanted to mention that we're so excited to share the impactful information on taxes. But this webinar is strictly informational. It does not constitute official legal, accounting, or tax professional services. So we really strongly suggest making sure you chat with your own tax professional or your accounting service about your specific business needs. And Oren is going to take us through this agenda today. So we're going to be covering quite a bit. We have tax essentials, getting pretty specific on what it means when you have a retail business, deductions, and like I said, that Q&A. So please, as we're going through this conversation, remember to drop your questions in the chat, because if we have time, we will get to them. So Oren, I'd love to ask you, how can small business owners who sell retail products online prepare for tax season?
Yeah, absolutely. It's a good kind of starting point here. And again, just to piggyback off what Brittany said, this presentation is really just to kind of inform you of everything that's happening in the tax world. Again, every business is different. You have your own situation, so I'm just going to kind of emphasize that. We really encourage you to work with the CPA or a tax advisor on your specific tax planning and strategy. But that being said, I've done a lot of work with taxes in the past, and I think I can give some pretty good recommendations here. So, we're getting close to tax season now. We actually have some deadlines coming up, which we'll talk about in a bit. But if you were to ask me what's my number one piece of advice for businesses at this time, it's get organized. And that covers a lot of different aspects. Getting organized with your business, with your financials, with your inventory, with your record keeping. So first and foremost, when we talk about getting organized, we have to talk about the very bare minimum here, which is keep not commingling personal and business transactions, right? You're running a business. You need to isolate all of that income, all that business income, that business revenue, and all of those expenses that you incur from your business. You need to isolate that completely from your personal income and your personal expenses. It's good for you so that you always know how your business is performing. You always know how much money your business is making. It's good for taxes. The IRS does not like to see commingling of personal and business transactions. It makes their job harder. It's good for if you ever need to capitalize your business, if you ever need to get a loan for your business. Lenders want to see in an isolated way. They want to see your business transactions in and of itself. So you gotta, if you haven't done so already, you gotta make sure that you're keeping those separate. Credit cards. If you have a personal credit card and you're using that to pay for groceries, and then you're also using that to pay for business transactions, you're commingling, and you need to separate that out. So that's really kind of bare minimum. If you haven't done so already, make sure that you develop an infrastructure for your finances so that you are keeping all your business transactions separate from your personal. You need to have some, also kind of under the purview of getting organized, you need to have some form of accounting system, right? That's more than just an Excel spreadsheet. If you are not able to pull a simple profit and loss report for any period of time with a certain degree of accuracy to see what your net profit is, if you aren't able to do that currently, you need to make some changes, right? You need to have some sort of basic accounting system, whether that's, QuickBooks. I think QuickBooks offers a self-starter kit for like $7 a month for the first year, something like that. There's tons of free accounting software out there. Something more than just a basic spreadsheet, something that where the system can do a lot of the work for you. It can keep things organized for you so that you can pull those profit and loss reports. You can pull those cash flow reports, and you can look at those reports. You can see what it's telling you with a certain degree of accuracy, so you know how well your business is performing on a regular basis, and you know what you're going to be reporting in your taxes, in your tax returns, right? So really important that you have some sort of system set up there. Retail businesses, Square is not an accounting system. It's a POS. It's a point of sale system. That should not be the accounting system that you use. You still need to have something more than that that can, again, track your revenue and your expenses, that can track your cash flow, that can track your assets on your balance sheet, so that, again, you can pull those reports. Inventory tracking, that's obviously very important for probably most, 100% of the businesses that are listening to this webinar today. You need to manage your inventory. You need to know how much inventory you're sitting on. You need to know how much inventory is on your balance sheet. Again, inventory are liquidable assets. So that's part of, your inventory is part of the valuation of your company, right? And these are all aspects that the IRS needs to know about. So you have to have good functioning inventory tracking. Good record keeping is also is an important factor here. You have to keep all those receipts, all those purchase confirmations. If you want to get those deductions, you need to be able to back up all of your invoices, all of those deposits that are going into your account. You need to track those back to the invoices or the purchase confirmations that you had that occur, from transacting with your customers, right? So good record keeping is also important. So all of this kind of falls under that umbrella of getting organized. That is by far number one, the most important thing that you can do, throughout the year, especially now that we're approaching certain tax deadlines that are coming up. It's just going to save you so many headaches in the future. Next, you want to know important deadlines, and we're gonna talk about this in a second. But I highly recommend you have all of those deadlines that are relevant to you and your business on your calendar, on your schedule, whether that's a Google Calendar or it's on a dry erase board on your refrigerator, whatever the case may be. Always know what those tax deadlines are so that you give yourself enough time to prepare for that. And lastly, if you are going to be outsourcing your tax and accounting needs, if you are going to be hiring a CPA or a tax advisor, I highly recommend you know what you need before going out there and shopping for CPAs. I find, and I learned this the hard way, and I find this to be the case with a lot of other businesses I work with, is when you go into it blindly, when you start talking to CPAs and they ask you questions and you basically say, I don't know, my accounting is chaos, my taxes are chaos, I have no idea what's going on, just make sense of it for me. You're really opening yourself up to a situation where you're going to end up paying for more than what you need. You're going to end up essentially paying for more than what you expected. A lot of CPAs, a lot of tax advisors pay by the hour or charge by the hour. So the more organized you can be, the less work, the less legwork that they have to do, the less you're going to have to pay in the long run. And tax accounting can get very, very expensive, into the thousands of dollars. So the more you can do, the more you can be organized up front, the easier it's going to be for them to do their job, the less complex it's going to be. Also, part of that is understanding the complexity of your business tax returns. If you have multiple LLCs, if you have a parent company and multiple subsidiaries, if you have real estate involved as one of your assets of your business, this all creates complexity to your tax returns. And that's all something to be aware of as you're shopping around for CPAs, to get to understand, okay, how much is it going to cost for these added layers of complexity? And kind of how to compare and contrast between different pricing and options. So again, if you're outsourcing it, get to understand a little bit about your tax situation first so you know what you're asking for.
Yeah.
Any questions so far before we move on that we want to tackle?
I think some of these questions you're actually going to be getting into pretty shortly here. So,
Cool.
I do want to say, like, I think mentioning deadlines was a perfect segue into our next question, which is when should small business owners start preparing for tax season?
Yeah, so preparing for tax season honestly is a year-round event. You should always be preparing for tax season, even right after you've finalized your 2023 taxes. Start thinking about your 2024 taxes. Again, and that involves getting organized. That involves knowing when those deadlines are, imploring any kind of tax strategy or tax planning that you worked with your CPA on for subsequent years. It's a daily process. But having said that, I get it. You're all business owners. You're all busy. So you can't think about this on a day-to-day basis. So at the very least, let's know what these deadlines are so that you can kind of start planning around that. So the biggest thing, especially for any one of you that have employees or 1099 contractors, you need to start preparing for submitting out your W-2 forms and your 1099 forms to your employees and contractors. And that deadline is actually coming up in 7 days. So if you haven't started doing that and you have employees and you haven't done anything, time to get a move on. Time to start making some moves on that. So again, if you have employees, you need to submit their 2023 W-2s to them so that they can use that to do their personal taxes. Same thing with 1099 contractors. You need to send out their 1099 form so that they can submit their self-employment taxes. So that's due January 31st. That's a hard deadline. There's no extension on that. Any of you that are S corps, your deadline for your S corp tax return, form 1123, I believe it is, that's going to be due March 15th. Same thing with partnerships. Now, partnerships don't need a formal tax return. It's actually just an information return. It's a little easier, but still, that deadline's March 15. Everyone else, sole proprietors, single member LLCs, shareholder income and deduction forms, that's all going to be due the same time that your personal tax return is due, which is April 15th. You can file for extension. So if you do file, if you're an S Corp and you file for an extension on your S Corp, you have until September 16th to file. Everyone else, October 15th is your absolute deadline if you're filing an extension. So that being said, now it's important to know these are just returns. These are just what you are reporting to the IRS. That is not the same thing as payments that are due. Oh, if we can live in a world where you can get extensions on payments due. Unfortunately, that is not the case. The IRS, they want their money. So unfortunately, you can't extend out tax payments. So most businesses, if not all of you, are required to submit quarterly tax payments on your net earnings. So for Q1, January through March 31st, that payment is going to be due April 15th. April to May 31st, that's going to be due June 15th. June 1st to August 31st, those payments will be due September 15th. And then the rest of the year, you have until January 15th and the following year to make those payments. Now, yes, you have to make those quarterly tax payments. If you don't, are police going to show up at your door and take you to jail? No. What's going to happen is you're going to just have to owe more money by the end of the day. It's going to be extra fees, extra penalties, and maybe you're okay with that. A lot of people are okay with that, but if you want to save as much as you can, you want to make those quarterly estimated tax payments. They don't have to be 100% accurate. That's what the yearly tax return is for, to kind of reconcile that and get you back what you need. But you definitely do technically have to make those quarterly tax payments. If you don't, again, you just have to pay some additional penalties, additional fees, which are nominal, but every dollar counts when you're running a business, right? So just something to think about. Reporting to the IRS is different from payments that are due. You have to make those payments when they are due. There's no extension for that. So those are some of the deadlines to be aware of.
Yeah, these are super helpful. And we have a couple of questions in the chat that I think might apply to this slide. Some folks are asking, they have a C Corp Is that the same as an S corp? Like, are these deadlines for them or deadlines for them as well?
I think a C Corp falls under the April 15th deadline, if I'm not mistaken. Yeah, it's just the S Corp specifically and partnerships that are due March 15th, I believe is the case. So C Corps, I believe, are April 15th. Yeah.
Got it. Perfect. Thank you. Okay, so we know that e-commerce businesses face unique tax requirements. So what are the common tax challenges for e-commerce businesses, and what can business owners do to prepare for them?
Yeah, so number one, first and foremost, is like the slide says, know what these taxes are that are relevant to your business. Some of these taxes are going to be specific to retail, some are just more general business taxes, but it's just important to be aware of them. Again, kind of going back to my big tips here is know what, most of you are probably going to hire a CPA or a tax advisor or whoever to do your taxes, which I honestly, I recommend that. You're busy. You don't have time to do this on your own and you don't want to make mistakes. But know what you're doing. Know what you're asking for. Have some relevant or relative expectation on what you're reporting, what taxes you're reporting, what payments you are making to the IRS on the federal level, to the state that you're based in, to states that you are selling in. Just be aware of it. That's honestly the best thing you can do to avoid challenges is knowing what to expect so that you don't get hit with huge penalties or huge tax payments that are due that you weren't aware of. Trying to and diving into that to your cash reserves or cash flow. To have to pay for those, making it more difficult for you to operate your business. So that's the biggest thing, is just being aware of what's relevant to your business. So with that said, actually, we can go back a slide really quick. So just to kind of go over these, we're going to go over these in a little bit more detail, but income tax, everyone has to submit a return for their income tax. Again, if any of you have W-2 employees, you have to submit your employment taxes. For those of you that are recipients of 1099, if you are freelancers or you are not a W-2 employee of your own business, you're probably going to be subject to the self-employment tax, which we'll talk about. Sales tax is obviously a big one. What you have to pay, remit and collect and pay for taxes on the goods that you sell. Excise taxes are going to be a little bit more specific to certain products, certain types of businesses, which I don't think most of you probably aren't going to fall into that category. And then we're going to talk about economic nexus. This is the big one. This is basically, taxes that you may or may not owe depending on which states you are delivering your product to. So we're going to get into that a little bit, and then we'll talk a little bit about, for those of you that are selling internationally outside the United States, what kind of duties, tariffs, international taxes to be aware of. So we're going to get into these in a little bit more detail here now. Okay, so income tax, that's kind of the very basic one. All businesses must file a federal income tax return each year to the IRS. That's for your business. That's also personally. It's going to differ. How that looks is going to differ depending on what kind of business you have, whether you're a sole prop or a LLC or an S Corp, and we'll talk about that, I believe, in the next slide. All businesses must also file a state income tax. However, if your business is based in either Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming, those states don't have state income taxes. Therefore, you most likely don't have to submit a state income tax return. So lucky you. Partnerships, again, I mentioned this before, only need to file an information return, which is a much more simpler document. And then again, I mentioned this before, but taxes are technically supposed to be paid, even though you're reporting it once a year. Taxes do need to be paid or make estimated payments throughout the year, not just at the time the taxes are filed. If that's what you end up doing, just paying the taxes at the time they are filed, you'll just have to pay some extra fees and penalties. And like I said, the type of business entity will determine how taxes are paid, which we're going to dive into that a little bit in the next slide.
And as we move through, I just want to let everyone know, because I see a couple questions in the chat, you will get a copy of the slides. So don't feel like you have to write everything down. Anyways.
Yeah, not expecting you to write everything down. You'll have to write very, very fast for that. I'm not going to go into this in too much detail. We can spend probably 45 minutes just on this slide alone, but I'm just going to kind of go over the basic, the core kind of concepts here, how taxes work depending on what kind of business you are. So we'll start with the easiest, the most simple, which is the sole proprietorship structure. Right. So for those of you that are sole props, you probably know, you are the business and the business is you. There is no differentiation. There is no, two separate legal entities. You are your business and your business is you, right? If you stopped running your business as a sole prop, the business ceases to exist. You can't transfer ownership. You are the business is you. So that being said, when it comes to business taxes for a sole prop, it really is just it really kind of integrates into your personal taxes, right? So for sole props, you're submitting your business tax information on your personal tax return, your 1040. The only difference is there's just an additional document that's involved with your 1040, your personal tax return, and that's most likely going to be the Schedule C. It's just one extra page on your personal tax return that basically just covers all your business income, your expenses that you're deducting, and whatever's left over, which is called your net earnings. And those net earnings are what become taxable. It becomes taxable income. So that's going to be your Schedule C. Schedule F if you're in farming. But most of you that are sole props that aren't in farming, you're going to be submitting a Schedule C on your individual tax return. Okay. That also includes single member LLC. So if you are an LLC and you're the only owner of your LLC, you're single member, you will also be filing a Schedule C. The way you submit taxes is as a single member LLC is very much the same as a sole prop. The only difference is you have a separate legal entity, which is the LLC, but from a tax standpoint, you're submitting taxes the same as if you were a sole prop. And then if we go to the other side of the spectrum here with the S Corp, now we are talking about a separate legal entity, right? You as an individual, you're a legal entity with a social security number. Your S Corp is a separate legal entity with a tax identification number. So you will be submitting a specific tax return for the S Corp in addition to your personal tax return. So it's just important to keep that in mind. The nice thing about the S Corp kind of came around to combat the disadvantage of a C Corp having double taxation. What does that mean? That means with a C Corp, because there are two separate legal entities, the business and the owner of that business, there was always double taxation. So the C Corp would be taxed on its net earnings, and then when those net earnings were then passed to the owners as pay, there would have to be an additional tax being paid on that distribution. So that caused this double taxation, which most people don't like paying double taxes. So that gave way to the concept of the S Corp. The S Corp essentially offers all the benefits of the C Corp, but eliminates that double taxation. So you're only being taxed one time. And the way they do that is what's called pass-through taxation. So basically the S Corp, what happens is the S Corp functions as a business, it makes money, it has expenses, it creates a profit or net earnings. What happens is instead of the S Corp being taxed at that point, like the C Corp is, those net earnings are the tax liability that's created from those net earnings that the S Corp created. That tax liability passes the S Corp level and goes directly to the owners. So it becomes essentially income of the owners, and then you pay a tax. You pay a tax as the owner of that business. So it avoids that double taxation. Generally speaking, most case scenario, it ends up minimizing your tax liability. So that's why we're seeing a lot of the S Corps kind of become more popular these days. So that just kind of gives you an idea of how the tax implications change based on the type of business structure that you have. LLCs are a little bit more chameleons in that sense. LLCs can be taxed in different ways. Like I mentioned before, a single member LLC will be taxed like a sole prop. A multi-member LLC will not be taxed like a sole prop. So it really just depends on how you set up the LLC. Again, I'm going to sound like a broken record when I say this, but consult your CPA or tax advisor on, based on your business structure, what's the best way to, set up your tax structure for your LLC.
Yes, this is such a helpful slide, and it makes me think that some people might be interested in thinking about like how their business is currently set up and potentially moving to a different structure, like you said, after talking to their tax professional, accounting professional. And I just wanted to share that we're going to be dropping a resource that just shows one of the amazing articles we have on our site that is all about changing your business structure. So if you're ever just looking for a place to go when you're starting to have these questions before you move on to your tax professional, just to get the lay of the land, I want to really encourage you to check out our business resource library. So we'll drop that in the chat, and then I'll move to the next slide.
Yeah, absolutely. And again, if you're a sole prop right now and you're considering kind of taking it to that next level, incorporating an LLC or an S corp, it's good to just check in with the tax advisor on this, because they can really help with your tax strategy, your planning overall. So kind of how to set up your accounting systems, and kind of how to set things up for your business in the best way possible. Because ultimately, we want to pay the least amount of taxes, and there's a lot of levers you can pull to do that. But probably want to consult a tax advisor on that. Okay, so moving on to employment taxes. Again, for those of you that have W-2 employees or contractors, just a few things to keep in mind there. So again, if you have employees, you have to file Form W-2. You have 11 days to do that for 2023. This reports payments to your employees, such as wages, tips, other compensation, the taxes you withheld, Social Security, Medicare taxes, things like that. You are likely paying or you're reporting your quarterly payroll taxes through your 941s. 941s are due for anyone that has employees. You have to submit your 941s every quarter, so that's separate. But when it comes to tax time, you would just want to make sure you're submitting your W-2s out to your employees. Same thing with contractors. So this only applies to contractors that you paid at least $600 to in the previous fiscal year. So you would have to send them a 1099 NEC, which stands for non-employee compensation, for any 1099 that you have that you paid more than $600. If you didn't pay them more than $600, you don't have to. They don't need a 1099. So just something to keep in mind with employment taxes. All right, so self-employment taxes. So I'm sure a lot of you probably this is probably relevant to a lot of you. So again, self-employment taxes are going to be relevant if you are a recipient of a 1099. If you worked with another business, they hired you for services and they issued you a 1099, you'll probably have to pay self-employment taxes. If you're a freelancer, or if you're basically not a W-2 employee of your own business and you're paying yourself through owner distributions, or things like that, then you're probably going to be subject to the self-employment tax, which currently is 15.3% on a federal level. So this only applies for if you paid yourself more than $400. Again, you might be a 1099 recipient, so that would qualify under self-employment taxes. And then just keep in mind, if you do pay self-employment taxes, you are most likely eligible for the qualified business income deduction, which is really, really nice. Basically, what that is you can remove up to 20% of your net earnings, put that to the side, and then get taxed on the rest. So you're basically removing up to 20% of taxable income, which is nice. It's a really, really nice deduction. It can be quite significant. So just make sure that if you are eligible for the QBI, just make sure that you are getting that's being incorporated in your tax return. All right, so sales tax. All of you know what sales tax is. You live it day to day. You see it. You see that that extra expense coming out of your bank account. So as most of you know, you must report sales taxes, which is the amount of based on the amount of sales generated, and remit that to the state-specific tax agency. There is not a sales tax on a federal level. This all happens on the state level. There are no sales taxes in the following states: Alaska, Delaware, Montana, New Hampshire, and Oregon. But there's a big but there. Alaska specifically will tax some services. And also Alaska, it's important to know that Alaska is a home rule state, which means it's mostly governed by, I think, 106 different jurisdictions. So every jurisdiction has their own tax policies, they have their own requirements. So if you're doing business in Alaska, don't just see that there's no sales tax in Alaska and just say, okay, forget about it. No, you actually have to look at the specific jurisdiction that you sold, that you delivered product to, and look at their specific tax policy, because you may owe sales tax in those jurisdictions. So that's why it can get a little complicated, because you're not just looking at things on a state level from a sales tax standpoint, but as we'll talk about with economic nexus in the following slide, you have to look at all states, and you have to look at all counties. You have to look at all municipalities. You have to look at all regions, districts in those states, to make sure that you are covered for all your sales tax requirements. So again, no sales tax in these states, but you still got to do the research. You still got to make sure that there aren't any more granular requirements within that state. So just keep an eye out there. Anyone with a reseller's permit, or any one of you that are purchasing wholesale items, you may be exempt from sales tax. So if you're, for instance, purchasing food items in bulk that you might be selling to a restaurant, depending on the state that you're doing that in, you may not be required to pay sales tax on those wholesale items. So just something to think about. Again, also some states may not necessarily require sales tax on groceries, health-related goods like medicine. So you got to check those local regulations just to make sure you're getting those exemptions. Excise taxes, I don't think this applies to most of you, but just so you're aware, excise taxes are, it's just an additional tax on specific goods or services, depending on what those products are. Fuel, tobacco, and alcohol are kind of the big ones. But if you are if you are in the telecommunications industry, air transportation, gasoline industry, coal, passenger ship transportation, fishing equipment, you may be subject to additional excise taxes, in which case you'll submit Form 720. So I would just check to make sure. For those of you that operate heavy vehicles over 55,000 pounds, truckers, truck dealerships, you might have excise taxes there. And then there's an additional excise tax for gambling, wagering, lottery, those types of businesses. So just again, I don't think this is relevant for most of you, but just something to keep in mind. We want to just check to make sure. All right, so we're going to talk about economic nexus. This is kind of a big one. This can be very much a rabbit hole. I can spend a whole hour on this, but I'm just going to kind of lay out the foundations of what you need to know about economic nexus, because if you guys are e-commerce businesses, online sellers, most likely economic nexus will apply to you. So what is nexus? Basically, if you make a certain amount of sales in another state, you may be required to collect and pay sales tax for that state. There are two different types of, so a state can either be destination-based nexus, which basically means that when you deliver a good or product to that state, the tax on that product, the sales tax on that product, will be levied based on where the customer is located, not the business. So if you're a California-based business and you sell to somebody in Alabama, let's say, I believe Alabama is a destination-based or destination sourced, which means you're going to be paying Alabama sales taxes on that product that you deliver, because that's where the customer is. On the other hand, the opposite is origin-based. So origin-based basically means the tax is levied based on the physical location that your business is based on. That determines the tax rate. So basically, if you sell to that person in Alabama, you're going to be paying California taxes because that's where your business is based. That's how origin sourced or origin based nexus works. Again, just to point out, Alaska, Delaware, Montana, New Hampshire, and Oregon are the only states that don't charge a sales tax, but we're going to show a couple examples here of why you actually need to look into that further. You can't just see that Alaska doesn't have a sales tax and ignore it. You may still have to remit sales tax depending on the situation. We'll talk about that in a second. Aside from, so also with Nexus, Nexus conditions can apply outside of just sales that you generate. So Nexus conditions can come about if you, let's say, hire a remote employee in a different state, if you're hosting a trade show, or if you're establishing a drop shipping relationship in a different state. Depending on that state, that could create a condition for Nexus outside of just making sales in that state. So something to keep in mind there. Again, I can't stress enough, it all depends on the state. And this is why things get tricky, because you really have to know every state, all the state requirements and the counties and districts and municipalities within that state. It's a lot of research. So it really just depends on the state you're doing business in. Let's go over a couple of examples here of how these variations occur between different states. So Alabama, we talked about Alabama. What happens if you are selling product to a customer in Alabama? Well, number one, economic nexus, that condition will apply only if your business generates at least $250,000 in gross annual sales. That's total gross annual sales, not just the sales you're generating in Alabama. So basically, they look at it as if your business is selling product to an Alabama state customer, and your business generates at least $250,000 in gross annual sales, you reach the threshold in which economic nexus now applies, in which case you will have to pay sales tax on that product. Alabama is a destination sourced state, meaning you will be subject to Alabama state sales tax requirements. So that only happens if you have reached 250,000 in gross annual sales for your business. Texas, on the other hand, is a little bit different. So their threshold is 500,000 in gross annual sales. So economic nexus is not established until you reach that 500K gross annual sales for customers that you are serving in Texas. Texas is origin sourced. So that basically means that if you deliver product to a Texas resident, if you generate at least 500K in gross annual sales, then you will be subject to paying your home state, the state that your business is based in. That sales tax requirement is what you will remit and pay to the government for origin source for Texas. California always is complicated. California loves making things complicated. So their threshold, again, that's 500,000 in gross annual sales, but they're actually destination and origin state. So if you are selling to customers in California, depending on where exactly they are located in California, within a municipality or within a larger district, that might change whether you are paying California sales taxes or you're paying your own state sales taxes. So you're going to have to look that up, because it just depends on exactly where in the state of California that product is being shipped to. Other conditions apply with California. So again, you just have to look and make sure that you're filling all those requirements. We talked about Alaska. Again, this can be a little bit complicated. So Alaska doesn't have a state sales tax, but again, big B, there's 106 local government jurisdictions in Alaska. It is a home rule state. So if you are shipping product, you have to know which jurisdiction that product lands in, and then look at their specific tax policy, because you may be subject to tax requirements there. The threshold for the state of Alaska to meet economic nexus conditions is 100,000 in gross annual sales. So you can see how this can get complicated. If you are selling to, here's what I would say. My recommendation, and this is just me, if you are selling in more than 5 states outside of your home state, things can start getting complicated. It's a lot of research. It's a lot of due diligence. Hire a CPA, let them do all the work. But that's just my recommendation. If you're selling in all 50 states, that's kind of a no-brainer at this point. You do not have the time to go through all 50 states, understanding their nexus requirements, understanding all their county, municipal, level requirements, regional requirements. You just don't have the time to do that. So that just gives you an idea of how this can all variate, and it all just depends on the state.
Yes, this is making my head, it's swimming. So much
It's a lot of
information here.
information.
It is. And so I just want to encourage folks, like I'm seeing some questions in the chat that are extremely specific to your business and probably even to like singular situations that you're dealing with. This is when Oren says you really want to talk with that professional who it is their job to understand this and make it work for you and your business. That is really what we want to encourage you to do, because they are going to have the best option for you and your business. We did also drop something in the chat. It's just a resource that shows that QuickBooks can help you calculate some of your economic nexus for sales tax. So that's something you can look at, but heavy on the talk to your professional, because there's a lot here.
Yeah, so with that, let's talk about some best practices. Let's talk about some things to maybe make some of this easier for you, because I know that this might feel overwhelming, but luckily we're in a place now where we have a lot of technology, a lot of resources out there to help. So number one, first and foremost, you got to make sure you're filing your business licenses in any state you're doing business in. I think there may be a couple states that don't require licenses, but most of them, if not all, you have to have permission in that state to do business, to generate revenue, to ship product to. So you want to make sure you're getting you're getting those business licenses in all those states. You want to determine where you're going to have state nexus, especially those destination based, because destination based states that they will have tax requirements that you are not aware of, because they're not the same as your tax requirements for your state. So you want to determine where you're going to have that nexus. Here's a nice one. Automate your sales tax bookkeeping with software. So a lot of accounting softwares will do these calculations for you. So they'll see that you ship product in Alabama, and they'll take the latest nexus information, those tax requirements for the state of Alabama, and the system will calculate everything for you, which is nice. However, number one, you want to make sure those calculations are correct. Sometimes accounting software may not have the most up-to-date nexus information. We have 50 states, so the likelihood of nexus information changing is on a frequent basis is very, very likely. So sometimes the software doesn't update in time. They should, but sometimes they don't. So you just want to verify that those calculations are correct. And number two, you still need to file and remit those taxes. The accounting software is not going to make those payments and file that for you. So you still have to do that. But what's nice about the bookkeeping software is at least they'll kind of do the baseline necessity for you of just making those calculations. Determine if you're eligible for any exemptions on Nexus. So a big one is sales tax holidays. A lot of states will charge zero sales tax depending on when that transaction is occurring. So you want to make sure you know what those are, so you're exempt from making any sales tax payments. Again, we talked about wholesalers. A lot of states will not require sales tax on wholesale purchases or resale purchases. So you want to make sure you're accounting for that as well. Number five, we already talked about this. Just let a CPA or let a tax advisor do all the work for you. Does it have to be a CPA? Maybe, maybe not, depending on the complexity of your business. I would always just go with a CPA, just because you know you're getting the best value for your dollar when you work with a CPA. But very experienced tax advisors, certified tax advisors, they should be fine as well. CPAs are also a little bit more expensive, but it's a trade-off. So either way, get a CPA or a certified tax advisor. Let them do all the work for you.
Oren, before we move on, there's a couple of questions about this first one about business licenses. And a couple of people are asking, so if they are based in one state, but they sell all over the nation with their e-commerce business, does that mean they need to have a business license in every single state?
Most likely, yes. Again, it depends on the state and what their requirements are. I know that off the top of my head, with California, when I was doing business in California, we had to file as a foreign business entity. So that wasn't just filing a business license, but that was also incorporating as a foreign entity. Some states may just require a very basic 5-minute application license that, comes back to you in a snap of a finger. But either way, you need to have permission to do business in a state. They need to be aware of, the state needs to be aware of who you are and what kind of business is being conducted in that state. So they need to know who you are. You need to be on file. So that's why we say there's going to be some sort of license or permit to operate and generate revenue in that state.
Gotcha. Okay, perfect. All right.
And then just to touch on a little bit on international. So many of you are probably aware of some of these terms. If you're doing international sales, from a tax return standpoint, there's really not much to keep in mind here because a lot of these taxes are assessed and charged to you at the time that you're conducting the transaction. So you're already, essentially, if you're doing business international, you're already making these payments. Your stuff won't get through customs unless you are, basically. So just to kind of keep in mind, just some of these terms to know about. Import duty is a tax imposed by a government on goods from other countries. The purpose of an import duty is it's to increase prices on imported goods, because what governments are trying to do of other countries are trying to make products from other countries less quote unquote desirable by making them more expensive. So it helps to support the domestic market. So an import duty is really there just to encourage people to buy from their own resident country as opposed to importing. We see a lot of agreements between different countries these days to eliminate those import duties to kind of help encourage more trade between different countries. Canada, the United States, and Mexico, we have an agreement. It was formerly NAFTA. Now it's something else. I forgot what the abbreviation is. But if you're doing business in Canada or Mexico, you're likely not going to have an import duty due to that trade agreement. But that's not to say that you're not going to have import duties in other countries overseas. GST is the goods and services tax. It's a flat rate percentage of the total transaction. You're going to find GST in places like Australia, Canada, and India. And then we have VAT, value added tax. So this is charged to consumers when they buy any good or service. You'll find VAT being charged in most European countries. If you're selling to Europe, 99% of the time you're going to be charged a value added tax. These other terms are just something to keep in mind if you don't know already. So you have DDP and DDU. So DDP is delivery duty paid. And basically what that means is the seller, you as the business, you're responsible for handling all the risks and costs of the shipment that's being made, including import duty and any other charges related to the delivery that's happening through customs. DDU, delivery duty unpaid. That's basically transferring that responsibility over to the customer or the receiver of that shipment. So they're responsible for settling all those charges in order for customs to release that shipment and have it delivered. So just some important terms to be mindful of there. All right, now the fun part, right? Deductions. This is we talked about, okay, all this money that you have to pay, all this money. Now let's talk about how to make sure you're paying the least amount as possible. So deductions, huge, 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 huge for businesses. Just to kind of think about this conceptually, why is it better to have a better to have a business than to not have a business, right? So think about you as an employee of a company. You have a W-2 wage, you get paychecks. Let's look at how that works transactionally. You make money, right? You generate income, personal income from working that job. Then you get taxes withheld, right? You pay those taxes, and then whatever's left over, you pay your day-to-day expenses, right? So you make money, you pay taxes, and then whatever's left over, you use to pay your daily expenses. With a business, it's different. You make money with the business, you pay your expenses first, and then whatever's left over, you pay taxes on. Why is that nice? You're going to pay less taxes. So we look at this in the form of deductions, right? So with your business, you make money, you deduct your business expenses from that revenue, and then whatever's left over is your profit or your net earnings, and that is what your taxes are assessed on. Is those net earnings? Most case scenario. So what can I deduct? To be deductible, a business expense must be ordinary. It needs to be common. It needs to be accepted in the field of business and necessary to conduct the day-to-day of your business. It needs to be related to your work, and it can't be something that you were already reimbursed for. All right. How do I deduct business or deduct expenses on my business taxes? So first and foremost, part of getting organized, part of good record keeping, you want to collect all those receipts, all those purchase confirmations, all those verified transactions that you've incurred over that tax year. You can't deduct, technically, you can't deduct an expense without having that supporting verified expenditure. And then, like I said before, remaining income after deducting those expenses, that's your net earnings, that's your profit, and that's what's getting taxed. So that's what's nice about having a business is you pay those expenses first and then you pay those taxes. So next slide, please. So again, I just kind of put that very simple formula up there. Revenue income minus expenses, that equals taxable income. Right? That's what you're paying taxes on. So what can you deduct, right? What can you deduct from that, from your total sales, from your gross annual sales to lower that tax liability? So many things. Most business expenses can be deducted. That's going to include the home office deduction. That's a big one. If you work out of your own home, and if you're paying for internet and you're paying for utilities and you're paying for office equipment, things like that, there's a deduction on that. Now you have to make sure that you're not deducting the 100% of your internet bill or your home office deduction, because that's also your house. You also operate your individual lifestyle out of that home, so you can't deduct 100% of those internet bills, 100% of those utilities, because you only use a partial amount of those utilities for your business, for your home office. So it's just something to keep in mind. Then you have your vehicle usage deduction. So if you use a vehicle for the purposes of your businesses, there are two types of deductions that you can take for your vehicle. You have to choose one. You can't do them both. It would be lovely if we could, but we can't. You have to choose one. So either you can deduct the total aggregate amount of all your vehicle expenses. That's the total amount that you paid for gas, the total amount you paid for car insurance, your registration, et cetera, aggregate that and deduct that as a business expense. The other way you can do it is mileage. So you can deduct 67 cents per mile that you drove for business purposes. I highly encourage you to do both calculations. Whatever is higher, that's what you should use to deduct, right? Again, you can only choose one. Okay, sorry, I'll speed this up. My apologies. You can deduct marketing expenses, insurances, payroll expenses, administrative. Pretty much, I would say 98% of your business expenses you can deduct. That includes assets that you depreciate, and of course that includes that qualified business income that we talked about. Next slide. Oh, I think that's it.
I actually think that we've covered so much, and I think you hit the nail on the head, Oren, when you said you could spend an hour on each of the different slides because taxes, right? So I just have one quick question. So what are some signs that a business might be ready for professional help? Like, when should they go?
Yeah, that's a good question. I mean, my personal recommendation is if you're already running a business, you're already ready to outsource those tax requirements. It's just the amount of complexity involved with your tax return is really going to help you determine to what extent of professional tax services you need. If you're a sole proprietor, you do some freelance work. If you're just filing a Schedule C, there's not a lot of complexity to it. There's not a lot of added elements like real estate or assets to depreciate, things like that. If it's super simple, yes, you can do it on your own. But again, you have to file that form. You have to know how to fill out that Schedule C, and there might be a learning curve there. But that's the simplest that it can be. It can be done, but it might just take some time to kind of learn how to submit that along with your personal tax return. The more complexities you add, additional entities, LLCs on top of LLCs, additional owners of the business with Schedule K1s, real estate transactions, asset purchases that you need to depreciate over time. That adds complexity that's probably going to require a professional to take a look at and pull those levers in the right way. I would also encourage you, if you do find that your business is getting a little bit more complex from a tax standpoint, you're operating in a lot of different states, talk to a tax advisor about strategy and planning over time. Don't just do what you need to do for 2023, but start talking about what the future looks like. Start thinking about how to set up your infrastructure and your tax strategy in such a way that it's going to make things easier for you. You're going to pay the least amount of taxes, and it's just going to be easy moving forward.
Yes, that makes so much sense, especially when you talked about the complexity. I think we really got into that today. And then I know you mentioned these earlier, but just so that our audience has something to take away with them, what is one step or action they can take today to get more prepared for this tax season?
Yeah, good question. Get your accounting up to date. Look at be able to track your revenue, be able to track your expenses, be able to track how much is left over, your net earnings. Make sure you have all of your receipts, all your purchase confirmations, get all your paperwork in order. Do not throw a bunch of crumpled receipts at your tax accountant. Do the work to get all that information yourself, minimize how much you're going to be paying a tax advisor. So get a little bit more organized with your finances, with your record keeping. The more you can do now, the easier it's going to be when you're working with an accountant, or sorry, a tax advisor.
Thank you so much, Oren. And we have answered some questions throughout the presentation. It just naturally worked out that way. So thank you, Oren, for adding that piece into this conversation today. Thank you, everyone who stayed a little bit later to get all of this wonderful advice. We have dropped a link to our coaching hub. You take anything away from this, it is that AOF is here to support you with resources and what you might need to watch your business have sustained and successful growth. So if you're still like, I don't know where to go from here, please go ahead and check out the coaching hub to just help you get some direction. We're super grateful that you guys joined us today. We're very thankful for our partners at FedEx for making this happen. And we hope that you all feel a little more prepared for this tax season. Thank you, everyone.